Hello and welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into the topics and trends that we've been exploring here at Quilter Cheviot. I'm your host, Simon Doherty, Head of Managed Portfolio Services based in our London office. And this week, I'm delighted to be joined by regular contributor and Head of Fixed Interest Research, Richard Carter, alongside Nick Wood, Head of Quilter Cheviot's Investment Fund Research Team. Good morning to you both. So, Richard, I'll turn to you first, if I may, and let's delve straight into UK politics. And the week just gone is certainly the one where the election campaign came to life. We've had the return of Farage, questions over claims of £2,000 tax rises, and a pair of fractious debates. Talk us through what's been going on, will you?
Yeah, it's not been a great week for Rishi Sunak, that's for sure. Everything that seems to happen seems to go wrong as far as he's concerned. As you say, you had Farage deciding to take over the Reform Party and stand in Clacton, which risks them taking off what remaining Tory voters there are, and then his decision to leave the D-Day commemorations in Normandy ahead of schedule or a bit early, and sort of leave David Cameron to pretend to look like the UK Prime Minister was embarrassing to the least, and again managed to offend, I think, parts of the population that he would have been hoping to vote Tory definitely, as well as everyone else. So it's not been great. As far as the markets are concerned now, I don't think it's been too much of a concern. A Labour victory is very much priced in. They're miles ahead in the polls. So although things are going from bad to worse for Sunak, I think as far as markets are concerned, it's pretty much a done deal that Starmer will be Prime Minister within a few weeks.
Yeah, thanks. And I'll just pick up on that because it's quite interesting and an area we discussed this week in our investment committees. So, recent polling suggests Labour has the largest lead over the Tories since March. And, I certainly read in recent days, some are even talking about the potential for the second largest majority in British political history. It does feel like a landslide Labour victory is priced in by financial markets, and specifically gilts, which you talked about last week in the session there, seem relatively nonplussed in terms of the anticipated victory there. It really is just all priced in and focusing on more broad global macro events.
Yeah, I think so. I mean, I guess there's always a danger that if Labour win this huge majority, and there's still some time to go, let's be honest. But if they do win this huge majority, they might feel emboldened maybe 6 months, 9 months down the line to, borrow a bit more, spend a bit more, and that could cause a few issues potentially for the gilt market. But I think for now, focus is on macro events, obviously US elections later in the year, what's going on with central banks, and I think the whole of the UK political class, or really sort of mainstream political class, has been scared and scarred by what happened with Liz Truss and the mini budget. So I think in terms of kind of fiscal policies, they're going to be fairly conservative and sensible for now.
Great, thanks. And focusing on areas that were perhaps less anticipated, some news from across the Channel in France and some more elections to look forward to.
Yes, indeed. Look forward to with dread, I think. So, yes, obviously Macron, the far right in France did, well as predicted in the European elections. And Macron has surprisingly decided to, in some ways call the French electorate's bluff by calling early parliamentary elections in two stages for the end of June and early July, and he'll be hoping, I guess, that it proves that he can put the far right under the microscope and maybe turn out that the electorate isn't so keen on them after all, and actually it was just a bit of a protest vote. But risky strategy potentially if they do well and pick up more seats in the parliament. Although we should stress in terms of wider implications and Euro and EU and all the rest of it. Obviously, the big prize is the French presidential seat, but that's not up for grabs for another few years. But certainly, markets will be watching how these elections go in France pretty closely, I think.
Yeah, plenty to keep us entertained on the political front. But if we talk about central banks, and obviously, we're coming into a time where attention is very much focusing there. One event last week was the European Central Bank cutting interest rates for the first time in 5 years. something you forecast in last week's Markets Uncut. But interestingly, the accompanying statement from the ECB emphasized, and I quote, it was not pre-committing to a particular rate path. At this point in time, do you think that's it from them in 2024?
Not necessarily just yet. I mean, I wasn't that surprised that their accompanying statement for the rate cut was a bit hawkish. Sometimes, at these turning points in the cycle, and they're not going to go and suddenly promise a whole series of rate cuts at the start, because inflation pressures are still fairly high, and they don't want to pre-commit to a sort of slashing of interest rates, and then it turns out they've got it completely wrong and have to reverse course. So I wasn't that surprised by the statement. I think for now, the next possible meeting where they might do something is September. It will really depend on how inflation dynamics sort of unfold between now and then. But they're going to take it gradually and wait and see what the data does, and then decide possibly after the summer holidays whether to cut rates again. But it's entirely possible. I'm not sure whether the politics in France or anything else will make much difference to what they decide to do. But I think obviously, as far as the wider economy and the wider sort of political issues, that's still potentially quite interesting. But it won't, as I say, I don't think it'll affect the ECB too much.
Great, thanks. And just looking across the pond, we obviously had Friday's non-farm payrolls in the US as well, showing the strength of the US labor market and getting far more jobs than forecast, over 270,000 versus consensus expectations of below 200,000. And if we look at Joe Biden and the accompanying statement, we are seeing the great American comeback continue. Interestingly, though, we also saw unemployment in the data release on Friday rise slightly to 4% from 3.9%. Now, some mixed messages, albeit, short-dated US Treasury certainly didn't take the news of that knockout non-farms figure too well. I guess to summarize, what, if any, potential read across do you see from this series of data to the FOMC meeting this week?
Yeah, I mean, you do have these separate surveys, and you do sometimes, there's the household survey and the establishment survey, and they sometimes do give mixed messages. It's not that unusual. A few analysts sort of saying, actually, if you want to look at the immigration trends, the payrolls number is probably a little bit more reliable and the one to focus on, and that's what US Treasury markets, as you say, certainly did. I mean, it was a sharp old sell-off after this non-farm payrolls number came out, and it's interesting because it's been, it was slightly at odds at some of the other data we've seen, job openings and things that have been softening at the margin. But as far as the Fed's concerned, there's no prospect of them cutting rates with non-farm payroll numbers like this. Wage growth also pretty strong as well. So the meeting this week, it'll be on hold, steady as you go, too early to cut rates, and they'll probably downgrade their sort of estimates for where rates could go this year. And previous sort of 3 months ago, they were suggesting it could be 3 rate cuts this year. There's not going to be 3 now by the looks of it. So they'll probably downgrade that to 2 or potentially less. So yeah, as I say, the US data, there has been some softening in some areas, but after these non-farm payrolls, I'm afraid it's back to the same old rate cuts. It's too early to cut rates at the moment.
Lovely, thanks. And interesting week ahead, and some news flow to look forward to for next week's update. So thank you for that. At this point, I'd like to bring in Nick. Bringing in Nick will give us all a break from the news flow focused on Westminster politics and central banks. And I'd like to discuss one of the bright spots for investors in recent years, which has been Japan. And Nick, you've been a long-time observer, visitor, researcher and investor in the country. And I think despite recent gains, it's fair to say it's a market where questions continue to be asked about the longevity of the opportunity there. And, particularly those with longer memories are often, slightly skeptical about investing large sums in the Japanese equity market. You just start off by talking us through what you've seen in recent years.
Yeah, and thanks for having me on, Simon. And it's still amazing me how many comments I get around investors burnt from the late 80s bubble, but those comments still definitely exist, and I think that's still in the market somewhere. Last decade, in no particular order, we've seen a lot of changes, but those are, if you think about material shift in how Japanese companies think about shareholders and corporate governance, that's been a clear improvement in that market. Slow process, but when you sort of measure it in years rather than months, you can see over time sort of real progress to the benefit of shareholders there. We've had inflation more recently at levels that the Bank of Japan has been aiming for years, and I say aiming for because everyone else in the world is aiming for lower. Bank of Japan consistently aiming for higher, coming from a more deflationary space. The stock market, as you say, is back in vogue, at least for the last 18 months or so. And then finally, I think key point really is currency, and the yen has been effectively sort of weakening in sort of fits and starts for over a decade now, and by any measure certainly looks cheap, driven more recently by that differential between sort of higher global interest rates elsewhere, notably in the US versus Japanese rates, which they've moved up, but they've moved up very slightly. They're still very low in an absolute context. Just to put some context around currency, when I was in Tokyo in November, it really did feel sort of a cheap place to be, whether that's your food prices, restaurant prices, or just products in shops that you might sort of routinely buy here in the UK. They're significantly cheaper over there. So if you're looking for a nice holiday, it's there are worse places to go, and it's maybe at a decent price as well. So a lot has changed anyway, and despite the very strong market performance, I think still, as I say, relatively unloved. And if you look at where global investors are typically overweight and underweight, Japan generally remains underweight and unloved. And I suppose that we've got that history, and that might be part of it. There are other things which sort of haven't changed actually. So Japan being unloved is one of those. We've got the aging population that remains an issue, and I guess we may have inflation, but actually the other thing that hasn't really changed is wage growth, which remains sort of low to negative. So there are plenty of things that have changed, and there are a number of things that sort of remain sort of relatively consistent.
Great, thanks. And we've both touched briefly upon that, recent performance from Japanese equity markets. Can you talk us through what's driven that uplift in recent times?
Yeah, it hasn't been entirely sort of one consistent area in the way that it's been in the US, where you're talking about a handful of tech names. There's been a number of things going on there. Maybe the key one though is again, it relates to the yen. Large exporters, and you might sort of put something like car makers in there. They've benefited from that yen weakness. They've performed well on the back of that, and that's sort of been a clear driver. But you've also got a number of other sort of smaller areas. So it might be stocks caught up in that sort of AI frenzy that is reminiscent of the US. Reminder that Japan's got plenty of sort of market leading technology names, and there's a handful that are AI related, something like Tokyo Electron, and they've done well. You've got individual stocks that have benefited when a company's made a really meaningful corporate change, and that's really had an impact on share price. But they're quite idiosyncratic sort of moves in terms of individual stocks. But I think it's interesting. One of the ways Japan's actually differed in the last 12-18 months as a market has been, it hasn't been driven simply by higher growth stocks. Again, sort of referencing US, Europe. It's actually you've got more stocks that you might commonly sort of call value companies that have done well. That part of the market has been sort of more leading the market. So we see where it go from here, but it's there's been a number of factors that have played into that market move so far.
Great. And I think if we just tie it in with, our positioning, Japanese equities are an area where we remain positive across client portfolios, generally speaking. And to excuse the jargon, overweight in our allocation is where we continue to be. Can you just briefly outline why you retain conviction in the prospects for the market from here?
Yeah, sure. I think it's really easy to be a little bit skeptical and go, well, look, Japan's done very well. We've made a lot of money. Probably should take some profit now and think of other sort of more interesting areas. And sometimes the market is a bit like that in terms of sort of. I feel particularly in Japan, you get these sort of fits and spurts of sudden interest, and then we move on in life to something else. I would say, from my perspective. Yes, the large exporters have done well, for example, that currency weakness, but that would account for a reasonable amount of that market rise. But there's plenty of other areas that haven't done so well. So you might look at smaller mid-cap companies which have struggled. Actually, they've been quite weak. You might look at sort of higher quality growth companies. So I'm not talking about sort of the AI related names. They've also struggled. So it hasn't been in the same way. There's a number of factors in the rise. There's been a number of laggards in the market, and I think that's where perhaps the opportunity lies at the moment. So if you look at our clients' portfolios, you'll see sort of many of our clients bias more towards more domestic, slightly smaller companies, and with a bit of a sort of a quality growth bias there. I'd say another factor sort of related to that. We keep talking about the yen, and the yen is by any metric sort of multi-decades cheap, and so potentially if that reverses at some point, that interest rate differential might drive that, or other factors. But if that reverses, as a UK investor, my ownership of assets in yen, if the yen appreciates, that's good for me. Now, the caveat to that is what often happens is the yen strengthens and the market weakens. So again, adjusting your portfolio to take that into account, to maybe think a bit more about companies that are less impacted by that. The small and mid-cap companies, I think, is relevant. But you're essentially buying into a very weak currency, and that potentially is a tailwind there. And then we have to keep talking about this story of corporate governance that continues to move along, and I'll mention some data that sort of has come out of the recent earnings season. We've seen just continued steadily increasing buybacks from corporates, and in April and May we had 2/3 of the prior fiscal year's buybacks announced just within those 2 months. So just shows you that the story keeps on going, and really that sort of reflects ongoing pressure from anyone from the Japanese stock exchange to activists to private equity and so on, and also just companies just dare I say sort of seeing the light, and often it can be that within a sub industry, one company makes a move and others will often follow. It tends to be a little bit like that in Japan, and so we have seen much more of that. So those are some of the key factors. Don't forget though that Japan, for all its sort of long-term decline as in terms of its weighting in global stock market indices, it's an area that's got a lot of market-leading companies. So if I think about, I've mentioned AI, but robotics and automation, that's something that I'm sure will continue to grow long term. You've got sort of incredible brands and IP, and just think of something, something relevant to my family at home, sort of Nintendo, and the brands that they own, and just one example, but there are plenty of those examples out there. So we're not talking about a market that's sort of lacking in market leading companies. So Those are some of the reasons to be positive. And it's, global investors are generally underweight today. You're seeing newer market participants sort of entering Japan. So it's now the second largest market for activist investors, seeing opportunities there. You're seeing private equity growing funds that are sort of Japan specific. So look, the new investors coming along, and definitely not without risk though. That yen strength, potential yen strength and the impact in the market is bound to cause negative headlines if it impacts the market. But so I'm certainly sort of not going in. You've got to go in sort of eyes wide open. But there's a lot of positives around.
No, thanks, Nick. It's really interesting to get those insights, and obviously a topic we discuss, very regularly, and something we could discuss certainly at length. So, would encourage listeners to look to our website, where Nick produces a lot of content delving into some of these areas in more detail. But really appreciate your thoughts there. And to you, Richard, as well. And thank you all for listening today. Just as a reminder, if you enjoyed our discussion on the podcast, we'd love for you to review the show wherever you're listening. And we'd also be grateful if you could share it via social media, tagging us at Quilter Cheviot in the process. Some good news, you may or may not be aware that Markets Uncut has been shortlisted in the Best Podcast category at the Investment Marketing and Innovation Awards. And with the winners to be announced in early July, we certainly hope to have some good news to share in a few weeks' time. So you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following #QC Weekly Comment on LinkedIn. As always, we'll be back next week, but in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. And you can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website, or indeed on our social media pages. Finally, if you have any questions you'd like to ask one of our experts in the next podcast, then please get them in via the weekly comments page on our website. We're certainly of the view that the more interactive, the better. But that's it for today. So once again, thank you to Richard, thank you to Nick, and thank you. We'll see you next time.